Jim Walker, founder and MD at Asianomics, joins us now from Hong Kong to talk about the global as well as Indian market environment. Jim, hi, always a pleasure having you on the show. Firstly, how do you see the political changes in the Western world influencing policies and thereby the markets over the next 6 months? Because there is fear over how, the socialist leader François Hollande, his win in France can lead to tighter regulations.
Yes, well, I think we're seeing with the French elections losses for the ruling party and the German local elections and the Greek elections in complete turmoil as regards the mainstream parties. This is the future of Europe and politics, I'm afraid, that given the way that countries are going into recession, very deep recession, really depression, given the way that the euro is structured and the fact that there's nothing that they can do to really promote growth policies with countries stuck at the exchange rate that they're stuck at, I think we should expect a lot more political turmoil in Europe over the course of the next, not just 1 to 2 years, but maybe even the next 5 to 10 years. But 1 to 2 will do fine at the moment. There's more problems coming along the pike for Europe. There's a lot more in the way of recession coming as well, and that, I'm afraid, is going to lead to turbulent markets and presumably, I would think, the return of the risk-off trade in the global equity market scene.
Morning, Jim. Nikunj also joining in from the Mumbai studio. What do you make of the U.S. economic data of late? Do you think U.S. economy has genuinely and truly turned the corner?
Yeah, we're relatively positive about the US, but of course everything is relative in the sense that when we look at Europe and what's happening in some other countries, including Japan, 2% growth in the US, 2 to 2.5% growth in the US looks really good. But by historical standards, of course, it's not particularly good at all. And the numbers at the moment really just support a US economy that's plodding along around about 2% growth, before it hits the fiscal cliff, of course, that is going to come next year as we move into a standardised programme of trying to reduce the fiscal deficit in the US, which will increase the headwinds of GDP growth. So economic growth in the US will be slow, steady this year, and possibly slower and maybe even not very steady in 2013. So again, it's something for markets to worry about. The offset of US against Europe this year is probably relatively temporary.
I just want to bring up some heavyweights, Jim. Just want to put perspective on how the market is actually behaving right now. Reliance Industries, and bring up that stock price up for you. We've cracked Reliance Industries, that's the stock that I'm talking about. Would just come up for you on your screens. We've cracked 700 as well on Reliance. 697 is where the stock is, and it's almost a free fall zone coming in for this one. It's down about almost 11 points, and that's the lowest level since Jan 6th that we've seen on Reliance Industries. And a crack below 700 is not going to go down too well for the technicals on this one as well. So that is how the market is behaving right now. Quickly want to talk about some other frontliners. While the index is at 49.78, you've got pressure building up for names like a SAIL, Hindalco. Even though the earnings were pretty good, the stock was pretty resilient yesterday, but that doesn't seem to be the case anymore. Hindalco under pressure, and quite so, 3% downtick coming in on the back of 2 million shares traded. DLF, JP Associates, Kotak Mahindra Bank, Sesacoa, Sterlite, M&M, Bharti, ICICI Bank, as well as Coal India are all falling like 9 pence right now. But yes, Reliance and a crack below 700 is going to be pretty meaningful. Jim, sorry to put you on the hold, but you had stated that the EU could impact emerging markets as well. Where do we stand post the LTRO injection in the Europe story?
I think maybe the markets are beginning to realise that LTRO was only a short-term fix. It hasn't addressed any of the major issues in Europe apart from papering over some of the banking systems, real problem loan areas and the cracks that were beginning to appear in the European banking system. But those cracks will reappear as we go into recession, which is undeniably happening at the moment, and the corporate sector in Europe begins to fail. Bad debts in the banking sector will rise. conservatism in the banking sector will rise, and that will mean that there'll be less in the way of extension of loans and renewal of loans to the private sector over the course of the next 12 months, which will further induce a downturn or reinforce the downturn that's already in place. So post-LTRO, we're in exactly the same position that we were in pre-LTRO, with a banking system in Europe that's failing, and an economy in Europe which is contracting. That's not very good news for equities and asset prices generally, not just in Europe but around the world, because it means that asset managers are going to go towards that risk-off position, which means lower prices and much less money moving around the system.
Let's look at the dollar index, and dollar index of course has meaningfully recovered in last 2 or 3 days. The dollar index is above 80. Strength in the dollar index means weakness in commodities. This is risk off. Also, this is a clear indication that global money managers are once again revisiting US dollar or US treasuries. Jim, for rest of the year, are you a dollar bull or are you a dollar bear?
Yeah, we think, of course, that relative to the euro, the US dollar should be strengthening, purely because there's at least some growth in the US and there's contraction in Europe. But having said that, it's been a very difficult bet to win over the course of the last year or so. We really expected the euro to be at parity with the US dollar well before now. Maybe we're headed that way now, but I wouldn't like to put a very big bet on it. I think the dollar strengthens certainly, and especially if the global economy begins to take a much more risk-averse position. Whenever that happens, the US dollar does tend to strengthen. But we would certainly encourage our investors to continue that hedge against the US dollar with one particular asset, and that's gold, just to make sure that the debasement of currencies, which the US continues to do, is hedged against with at least holding something that's in solid fundamental short supply, and gold certainly meets that bill.
Jim, a big concern right now is also oil, especially for net importing nations like ours. What is your view on oil over the next 6 months, and whether or not we can see a correction?
Well, it's good to see that oil has come off about 13% from its recent highs, because when it was hitting $125, $128 to the barrel, we were getting very concerned again that what we call the global consumption tax was being reimposed in a big way. That consumption tax is basically on billions of people around the world, which then just concentrates money in the hands of thousands of producers. The spread is not very good in terms of overall demand. So the good news is that oil prices are back down to about $111 on Brent crude, which is the main benchmark that we look at. And hopefully from here, as people realise that Europe is going to have a very weak economic outlook, that growth is weakening in China, weakening in India, and weakening generally in Asia, although we're quite happy with most Asian economies, but certainly slower GDP growth. That's a bad backdrop for high oil prices. And if we could just get rid of some of the concerns about Iran and Israel, then hopefully oil prices are heading below $100 a barrel. And that would take a lot of the pressure off of the importing countries around the region.
Jim, do you think India's balance of payment position and current account deficit is a grave concern? And how do you view India on these parameters versus its global peers?
The current account deficit is a concern because it's been over 3% of GDP, and that really tends to be the level that we look at as being unsustainable, and that things need to be done to address the deficit in case it goes much higher. But of course, part of the reason for that deficit is high oil prices and high commodity prices. So with the possibility of slower growth in the global economy and commodity prices coming off, that would be a big relief to India, and would help address some of that current account deficit problem. But really the current account deficit, as much as anything, is a symptom of the problems in India, which stem from the fiscal deficit and far too much money being spent by the government, far too many subsidies being put in place by the government that encourage the overuse of things like imported oil. So it's the fiscal deficit and the way that the government is running policy that we would be focused on rather than the current account deficit. To a large extent that'll take care of itself, especially as the Indian rupee continues to slide, and it's already probably oversold at 54.5.
Okay, Jim, just stay on with us. Just want to mark the new listing of the day as well. Tribhuvan Das, and the initial rates were 115, which is a discount to the issue price of 120 on TBZ. And the first rates would just now come up for you on your screens in just seconds from now. Meantime, the overall market momentum in any case is that of a weak one, so don't think it's the best day to be actually having a new listing. 49.80 though on the index, a marginal recovery from the lows of the day. And TBZ lists at a discount to its issue price of 115. Jim, just want to get back to you. What do you think are the factors that would continue to support GDP growth in India? And do you observe any structural change in the GDP growth, savings growth, as well as investment growth? And how do you view India's GDP compared to the global peers?
I think we're going to see a significant slowdown in the investment side of the economy, certainly through 2012 and maybe into 2013. Again, that's partly been caused by higher interest rates as the Reserve Bank of India has had to respond to the increasing fiscal deficit by the government. But also, of course, that that deficit spending by the government encroaches on the private sector. It starts to take money away from private investment, and furthermore, given that policies have been all over the place in India, there's a weakening in the certainty levels about what to invest in. So all of those together certainly weaken the investment case, and as investment weakens partly through that slowing growth, you get a downturn in earnings, which again weakens the savings environment in India. So there's, I think, investment problems in the economy that will certainly lead to lower growth. But of course, as I mentioned earlier, the weakening currency starts to stimulate exports and discourage imports. And we might be seeing a surprise probably in the second half of this year into the first half of 2013 about a turnaround in the external accounts as India's currency begins to make it much, much more competitive. So that's where the growth might well be coming from. Or certainly the increase in contribution to GDP and improvement in the net external accounts.
Jim, what are your thoughts on inflation, and what could be the impact of high inflation on India's GDP growth?
I don't think people should be too focused on fuel hike-induced inflation. I don't think the Reserve Bank of India would be. That's a one-off event, and it's something that actually should have taken place already if the government had been adjusting policies appropriately over the last few years. What it does mean, of course, is that as those prices rise, there's less spending in other parts of the economy, there's less activity in other parts of the economy, and that then begins to depress prices for goods and services. So the offset for the higher fuel prices is lower prices for other goods and services. Again, I don't think we should be too worried about inflation being induced from those higher fuel prices. It will take care of itself, and that won't really need that much of an adjustment on the policy front, certainly not by the RBI.
But Jim, what is your view on Rupee? The fact that Rupee has plunged to a 4-month low against the dollar. Do you expect in the near term Indian currency will remain under pressure?
The Rupee probably is already undersold, or oversold, sorry, around about that 53.5 level. It could go to 54, 55, maybe even slightly above that, depending on how the government runs policy over the course of the next few months. I think more than anything it's been government policies that have undermined the Rupee, and unless those change, then we could see further downside. But the good news is that at the levels that we're at the moment, India is becoming increasingly competitive, and that should begin to stabilise its current account position and begin to induce more economic growth through that net external account balance. So not an awful lot of downside, I would say, from here, given that we're at an oversold position on our calculations already.